Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily, Bauman Letter, and Profit Switch. Wow, I'll get you probably know what I'm going to be talking about today. Yes, it's all about the Wall Street bets blow up. Before I do, a couple of housekeeping things. First, here's a chart showing recent performance of American Airlines, a stock that I recommended last week. As you can see, it has spiked in price. And of course, we know why that's the case. It's because it's been caught up in the same attack on short sellers as everything else, but we'll take it as we can get it, folks. Take your profits while you can if you did buy it when I suggested it. The second piece of housekeeping is a couple of people asked about the position in a company called, or rather a ticker called MBACU, NBACU. They pointed out that it includes warrants. You can actually just buy NBAC instead. That's a company that is involved in charging stations. It's right, you can just buy NBAC just for the stock without the warrants, but my observation was that the offering with the warrants, which include 1/2 of one ordinary share and a right to receive 1/10 of an ordinary share on the consummation of the merger, is actually enjoying better price action. So it's up to you what you want to do. I think it's safe to go ahead and buy the warrants as well. My prediction is that they're going to be worthwhile for you. Now let's talk about the situation. The blow up in GameStop has cost short sellers over $5 billion each year, and here's my reaction to that. One of my favorite people in the world, SpongeBob, he pretty much expresses my feelings about this. I, like a lot of other people, feel that this is a good thing, actually. I think it's a well-deserved wake-up call, and a lot of people have been woken up, that's for sure, certainly in the media. All right, now let's look at GameStop's actual stock performance. This is a 5-day chart. Now, as you can see, the real action started last week. It peaked yesterday, or 2 days ago, and yesterday, and now we're back down again. Now, I have a feeling that despite the fact that all this stuff has raised issues of the little guys versus the big guys, I have a feeling Wall Street is going to have the last laugh on this one, and I'm going to explain to you why today. The bottom line is that Wall Street controls most of the gold, and in terms of the golden rule, they get to set the rules, and I'm sure they're going to set the rules to benefit themselves on this one. Now, let's talk about some of the little or lesser known facts behind this whole thing. One of the things that we've noticed is that there's been a lot of focus on the fact that retail traders are able to do all these things because they have access to apps like Robinhood that allow them to make these bets very quickly. They can enter and exit positions really literally while they're on the go. Well, interestingly enough, as we know, Robinhood and a couple of other brokers essentially banned trading in GameStop this morning, and that's what accounted for, I'm recording this on Thursday, that's what accounted for the big drop in GameStop today, because basically the liquidity dried up, because all the liquidity was coming from people who tend to do things on apps like GameStop. Interestingly enough, a lot of people have switched over immediately to Square's Cash App, which also allows you to trade. I'm not sure what's happening with that, but I think there's been a migration to Square's Cash App where you can even buy stocks with Bitcoin. So if you want to play two interesting wild trends at once, you can do that. Now, here's an interesting factoid. A company called Melvin Capital had a short position, huge short position in GameStop. You probably heard about this, and it was bailed out to the tune of $2.7 billion by Citadel, which is another big investment house run by a guy named Ken Griffin, and it is a pretty big bailout because it covers their short position in GME, which meant that effectively they probably took that $2.7 billion, bought as much GME as they could get their hands on, and then covered their short. The question is, did they do it before or after Robinhood banned trading on GME? My guess is that they probably did it after, and here's why. Basically, Citadel has multiple financial interests in Robinhood. Citadel is an investor. Ken Griffin has been an investor, a backer in Robinhood, and that has allowed him obviously to have some connection with the people who manage Robinhood. Now, what that means is that looks to me like conflict of interest. I mean, guy comes in, one of his pals has got a short position. He agrees to bail him out. He then decides maybe to influence his friends over at Robinhood to ban trading on that stock, in that short stock, which leads to a reduction in its price, which in turn means that his buddy is able to actually get out of his short position without suffering as much as a loss. I'm not saying that that's actually what happened, but it's certainly possible. And that's why I say, Wall Street has all these connections amongst themselves that we little guys don't actually have, and they can use them, and I think they probably do use them. Now, remember, that's not the only connection between Citadel and Robinhood. There's another one. Citadel is Robinhood's biggest provider of order flow. Now, what is order flow? Well, basically, the way order flow works is that when you're a retail brokerage like Robinhood, you take trades, but you don't actually conduct the trade yourself because you don't have the mechanism to do that. You're offering trading for free, so you wouldn't be able to do that if you actually had to be a brokerage yourself, or rather a trader yourself, a market maker. So what happens is that Robinhood makes deals with companies like Citadel, for example, and other companies like Virtu to execute the trades on behalf of Robinhood. So when Robinhood gets orders from, for example, Wall Street Bets folks, they then pass those orders on to Citadel and Virtu and others to execute them. And those others, Citadel included, actually pay Robinhood for those orders. Why? Because they're able to capture the bid-ask spread between the bid price and the ask price for the stock as their income. Now, what's interesting is that this actually is a very profitable business. Here's a little factoid I picked up around Virtu, which is the second biggest payer for order flow after Citadel. In the year from the second quarter of 2019 to 2020, Virtu's earnings from market making, which is basically doing the trades on behalf of Robinhood and people like Robinhood investors, increased 267% from the first quarter of 2019. But during the same period, money spent on order flow only increased 167%. Now, what that means is that by a smaller expenditure on buying order flow, buying the orders from a company like Robinhood, they actually make a bigger profit because they get a bigger share of the actual brokerage, the actual market making, the trading of the stocks themselves. So what it turns out is that a company like Citadel actually has a strong interest in trying to get as much business from Robinhood as possible. So why then would Citadel perhaps have influenced Robinhood to shut down trading in GME? Well, I've posited that maybe it's because that means that having lent money to this other brokerage, Melvin Capital, that basically it improves Melvin Capital's position because they can sell or settle their short position at a lower cost. But the other one could be just because they don't want Robinhood to get caught up in any SEC violations, investigations, White House investigations, congressional investigations. They want to make Robinhood look like they're doing the right thing so that Citadel can keep providing order flow, or rather buying order flow from Robinhood, because they make money on the deal. Again, they pay Robinhood for the orders, they execute the orders, they pocket the difference between bid and ask, and that is equal to more money than they would get if they just weren't doing the whole deal at all. So it's actually a worthwhile business to be in, and that might explain also why they might have encouraged Robinhood to back off. Now, this has been a pretty booming business. Here's a chart that shows basically the boom in trading volumes over the last sort of 8 years or so. And you can see that Citadel and Virtu are the two biggest players in that, and they just took off like a rocket at the beginning of 2020. Now, part of that is due to the increasing popularity of free trading apps like Robinhood, but a lot of it just has to do with the fact that at the beginning of last year, everybody was stuck at home. They had extra dosh in their pockets because of COVID payouts and things like that. And so they started trading a lot. So these guys are making a lot of money on not just, they're paying for order flow from Robinhood, but they're also making money because of that bid-ask spread. Now, fundamentally that explains, I think, the background of this. But again, this is a case where a lot of people misunderstand. Robinhood is not there. It pretends that it's helping retail investors, and in a way it is. But it's also providing a way for Wall Street big guys to make a lot of money, and they're making a lot of money in the background here. So my sense is that they're banning or that they're pressurizing Robinhood to crack down on Wall Street bets trading because they want to preserve that golden goose. They want to keep that cash flow. Now, here's an example of how much money is involved. Here is a statement of Robinhood's income from basically from payments for free order flow, that's PFOF, between the Q1 2020, Q2 2020. Now look at the jump. Basically 122% jump just in one quarter for overall equity trading, 86% jump in options trading, a total of nearly 100%. So basically, Robinhood doubled their income from payment for order flow coming from companies like Citadel and Virtue just over that one quarter. So again, there's big money moving back here. So the process by which the little guys are admirably, hitting these short sellers, and trust me, I don't like short sellers. Andrew Lefton, Citron Research, is one of my most hated people on Wall Street because of what they've done to stocks that don't deserve it. And I believe that they are market manipulators. But the bottom line is that I think at the end of the day, Wall Street will figure out ways to make money doing this because they always do. They have the rule makers on their side because they have the money and the access to the politicians who make the rules to make sure that things go their way. Now, there's a couple of other ways that the big guys can make money out of these deals. Some are shady, some are not so shady. For example, it's possible for market makers to front run trades that they acquire by paying for order flow. They get an order flow, let's say, from Robinhood for X number of GME shares. But instead of executing the trades right away, they first go in and acquire that many GME shares for their own float, their own trading account. Then they execute the orders, and that pushes up the price of GMA shares, which they then sell back into the market. And that not only do they get the bid-ask spread, they also get the higher price of the shares. That's illegal, but I bet it happens, and I bet it's been happening this last while. The second one, which is a lot more clever and what a lot of people have been telling GME to do, is what AMC Theaters did. AMC basically has made a $700 million out of this thing. What they did is that they took $700 million off their balance sheet by converting debt to equity because their share price had risen. They basically said to their creditors, look, we'll give you shares in our company at this price if you retire our debt, and that worked out fine. They also raised $506 million by issuing new shares at the higher prices, being driven by the Wall Street bets phenomenon. So, and then on top of that, one more on Thursday, they issued another $600 million worth of shares. So basically, these guys have managed to increase their cash position by nearly $2 billion thanks to Wall Street bets. Now, I doubt that's what people had in mind when they started doing this. They really wanted to hammer the shorts. But it just goes to show you that when money is involved, somebody is going to win, and it's usually the guys with the most money to begin with. Now, what's my opinion of all of this? Well, the first thing I think is that it shows the wisdom of a quote that came out this morning where somebody said, if someone on Main Street loses half of their portfolio in a day, nothing happens. But if a hedge fund does, they literally stop trading to protect the hedge fund. That's an illustration of what I'm trying to say. But fundamentally, this is a rigged game, and it will remain a rigged game as long as, our political system allows it to be. The second thing is that I think going forward, everybody's got to take into account a new set of risks. Is a particular stock susceptible to a Wall Street bets pumping action? Where everybody says, "Hey, let's pump this stock to screw the shorts." Well, yeah, I think that's something that you got to think about, particularly if you're looking at growth stocks that are in new spaces. NIO, for example, one of the big Chinese EV manufacturers, is already being hammered, or was part of the Wall Street bets phenomenon. So, when you start looking at a stock, you're going to have to think to yourself, what is Wall Street bets saying about it? Because if they're going to jump in and start doing this stuff, well, maybe you want to get in on the ride, but maybe you want to get out before they do. Whatever it is, it's going to distort the actual market signals that we all rely on to make their investments. The third thing is that, a lot of people criticize the Wall Street bets people by saying that, they're just disaffected and they're not taking this stuff seriously. But at the end of the day, I don't buy that criticism at all. I think, the biggest problem is that both political parties in the United States are far too friendly with Wall Street. They're far too soft. They're far too reluctant to really make any kind of serious attempt to regulate an out of control financial market. And so in a certain way, I sympathize with them. I mean, I think what they've done is arguably perfectly legal. It's not like people were, making up lies about GameStop. They did all this, on the basis of a bull thesis that was put out. I think most of them went along for the ride, but ultimately this is the way markets work. People talk about stocks, they buy stocks, and they sell stocks. You can hardly blame people for having done it on the internet. But the last thing is something that has been on my mind for a long time, and that is the fact that the whole world is really turned upside down. The things that we assumed used to move the planet are now essentially not doing it. Instead, what's happening is that representation, the way that we see things, has become more real than reality. The people on Wall Street bets are a reflection of that. They are not the real stock market, they're a reflection of it, and they have managed to become more powerful than the stock market itself, if only for a little while. And that reminds me of a book I read years ago by a guy named Guy Debord called The Society of the Spectacle. Here is the cover. I encourage you to read it. It's pretty unorthodox reading. You may be surprised to hear me recommend it, but to this day, it remains something that informs the way I look at things, because sometimes we lose sight of what's real and what's not real, and I think Mr. Debord explains why. Anyway, that's all from me. Ted Bauman signing off. I'm going to be talking to you again next week on Friday. Who knows what's going to happen between now and then. Take care.